we are seeing the bearishness when it comes to Chinese stocks or Hong Kong stocks. This chart on the Bloomberg just showing how bearish investors are with the put-call ratio remaining elevated for Hong Kong listed stocks. Why do you like Chinese equities?
Yeah, morning. Yeah, it's certainly true that Chinese markets currently don't have many friends. Although, if we just go about a month back or so, China, especially offshore, was actually probably the best performing large market. It's not so long ago. So basically, what it shows you is these sentiments can swing very quickly. But why have we upgraded it? In particular, because it's the only really large economy on the planet right now that is actually losing. Right, everybody else is either standing still or tightening, and we're seeing very early signs, be it in the property market, property pricing, where seeing some stabilization. We do expect a little bit more loosening. Actually, if you tie it in also in with the massive underperformance that we had seen over the last 18 months or so, still think there's reason to believe that this is attractive rather than something to be too scared about.
Will loosening and monetary easing be able to offset the fact that we continue to see more COVID lockdowns?
Yeah, that certainly complicates the equation a little bit. We have in our estimates, in any case, not gone for the whole GDP target that has been put out. So we're slightly below that to also have a bit of buffer. But we should come ultimately to the vicinity. And if growth slows too much, that there's always enough room also for the PBOC, for example, to loosen, for the government also to, on the fiscal side, to even do a little bit more. That there is buffer there for these measures.
What are the biggest delays? Is there a pretty big risk that we see the macro turnaround taking longer than expected?
I wouldn't say it's a large risk. It can be delayed by maybe a couple of months. That is possible because of the current COVID outbreak. But look, we had COVID pretty much in many other places, including actually two years ago in China already. So we know how the market looks at it, and it's very cautious, sometimes scared even at the beginning. And then, oftentimes even before these waves are peaking, the market's already sort of finding its footing again. So I wouldn't be too negative, because we have one of these episodes that we have also seen in many other economies before, and that do not in a lasting fashion influence markets.
We are, of course, seeing global bonds extending the route when it comes to credit in the US, the worst quarter since 2008. There's lots of fears about the surge in inflation, even stagflation as well. Where do you find opportunities in the bond space now?
Yeah, on the bond space, we still favor the ones that are floating rates. So because that I think is pretty much a done deal. We can argue how many times the Fed will hike this year or even next year, but it is broad consensus they'll hike a couple of times. And also, you, in our view, are early enough in the cycle, say 2 years or so, just over 2 years in the cycle, where you can still also take credit risk, especially also in the U.S. and especially also when some of it being energy that is very well shored up right now. So in other words, U.S. senior loans or some of also of the private credits is what we like right now, as long as they have floating rates.
Hartmut, across emerging Asia, do you see any opportunities, or are the risks facing EMs too great given what we see going on in China, and then also what we see with the elevated monetary policy risk from the Fed?
No. China actually, we believe, it's pretty clear they have a bit of a cycle of their own, shouldn't be too rate dependent. And also, if I look at just the performance of the Chinese market again over the last 18 months, it doesn't really suggest that you're extremely rate sensitive to the U.S. at these levels. I mean, a lot of the previous growth stocks have become value stocks by now. So that is something that I don't think should have too much of an influence. And here also in the regional strategy, as you mentioned at the beginning, we're still pulling through with that overweight on China.
How much further do we see that rally when it comes to financials? We are seeing, in particular here in Australia, the banks are one of the few leaders in what is an overall down day. Is there much of a sustained boost given that we do see rising yields?
Yeah, no, it's a valid question. We have in our strategies set the financials, not only banks, by the way, also to some extent insurers, or especially also life insurers. We had those included, but then also, for example, in Europe, not too long ago, even before the war started, we have taken it down because the rally was very, very strong. So yeah, I would agree that it is still an interesting place to look at it, but. When they have a good rally, then you can also clip the positions already a bit. I mean, they have run for quite a while already.